Choosing the right shareholder model for a company is fundamental to its future success and, it would appear from research, the happiness of its workers. Who owns a company? Just as there's more than one way to cook an egg, or peel an orange, or skin a cat, as the proverbs go, so there are many ways to build a business. Once the market for the new venture's products or services has been established, the next key question is, how shall we structure the company? Choosing the right shareholder model will be fundamental to its future success. Let's take a look at who owns a company. Many companies are listed on the stock exchange. These are publicly owned companies in that their shares can be traded, such that part ownership of the company changes all the time. The largest shareholders get seats on the company's board of directors and a say in developing its strategy, the key decisions it makes, and what instructions should be given to the CEO and other executives. Smaller shareholders tend to buy and sell stocks in the company according to market trends, pushing the company's share price up and down. The reality, though, is that just a small number of the world's biggest companies control many of the brands you encounter every day. For instance, in the food and drink sector, just 10 companies control almost every large brand in the world. These companies, Nestlé, PepsiCo, Coca-Cola, Unilever, Danone, General Mills, Kellogg's, Mars, Associated British Foods and Mondelez, each employ thousands of people and make billions of dollars in revenue every year. Then again, many companies never list on the stock exchange. They prefer to remain privately owned, to stay independent. Privately owned refers to a company that is not publicly traded. This means that the company either does not have a share structure through which it raises capital, or its shares are bought and sold without using an exchange. Privately owned companies include family businesses, sole proprietorships, and the vast majority of small and medium-sized enterprises. These companies tend to fulfill their financing needs from personal savings, family contacts, and retail banks. But not all privately owned companies are small. Some of the most famous companies in the world are private companies, such as the furniture giant IKEA or the huge food and agricultural producer Cargill. Both public and private companies have their advantages. Let's have a look at a few. Advantages of public companies. Their financials are audited and made publicly available. Their shares are available to buy, sell, or trade from brokerages. They are obliged to produce quarterly earnings statements and a transparent annual report. Advantages of private companies. Earnings from the company can be paid directly to shareholders. They have the potential to become public at a later date, an operation that can generate high returns for initial investors and shareholders. Investors are more involved in the management of the company. And then there is a third category of ownership: companies owned by the employees who work in them. About 10% of Americans hold equity stakes in their workplaces. By providing workers and employees with opportunities to buy shares, companies can help them raise their standard of living while feeling more invested in the success of the company. In this way, worker buyouts have also been found to increase a firm's competitiveness. And according to the Harvard Business Review, research suggests that employee-owned companies are more durable and resilient during economic downturns. Employee-owned companies are not just small groups of artisans or craft workers. In the US, some companies with stock programs mainly owned by employees, such as Publix supermarkets or outerwear maker W.L. Gore & Associates, are leaders in their industries. The largest industrial federation of worker cooperatives in the world, Mondragon Corporation, is one of Spain's top 10 multinationals, with about 12 billion euros of revenue from around 100 cooperatives, and 75,000 employees stretching across Europe, Asia, South America, and the USA. Other big employee-owned companies include the Canadian engineering company Golder Associates, retailer John Lewis in the UK, and Huawei Technologies in China. Employee ownership certainly seems to be a way of making workers happier, according to an analysis by Rutgers University and the Sloan Research Foundation. They investigated data from surveys involving nearly 250,000 employees in 800 companies. After compiling the data from all these surveys, we found that companies that offered workers both equity compensation and profit sharing performed statistically better than the others on a variety of measures. For example, their workers were substantially more likely to say that their company had a collaborative management culture, they were getting paid better, their company was an excellent place to work, they intended to stay at their company for the long term. The bottom line, the research found, is that sharing the fruits of a company's success with workers makes them happier while helping the company's profitability, proving that shared capitalism can indeed reduce inequality. So, you see, the ownership structure of a company matters very much, especially to those holding the shares.